Welcome back to Investor Insight. I'm David. Today we're looking at one of Warren Buffett's most revealing statements about predictability in investing. He says something striking. I know where Apple will be in 5 or 10 years, but I have no idea where car companies will be. This isn't just about Apple versus automobiles, it's about understanding what makes a business truly investable. Buffett and Charlie Munger break down why the auto industry, despite its size and importance, remains a capital destroyer for investors. Let's watch.
The global trends, it increasingly does seem that zero-emission vehicles may have finally reached the cusp of mass adoption. Do you see any opportunities in this space, either in specific vehicle manufacturers or in related technologies?
Well, I would say that Charlie and I for long have felt that the auto industry is just too tough. You know, the Ford Motor Company, Henry Ford looked like he owned the world with the Model T, and he brought down the price dramatically. He took up wages dramatically. He might have been, with a different personality or some different views, he might have been elected president of the United States. There's a good book that came out on that recently that told about the story of tells a little about Nebraska in terms of it, but Henry Ford and Thomas Edison joining up, but maybe a year or two ago. If you're interested in autos, you ought to read that book. But Henry Ford did that, and 20 years later, that they were losing money, and they had a guy with a gun in his pocket. I think Harry Bennett, that was running the Ford Motor Company. It was on its way to the junk heap when the whiz kids came in, and Henry Ford II, Hank the Deuce, as they called him, brought in Tex Thornton and my friend R.J. Miller and a few people. But it's just, I was reading the other day, actually, the 1932 annual report of General Motors. And it's one of the best annual reports I've read. It's a totally honest, assessment of exactly where they were. They had 19,000 dealers then, and the population, as I mentioned earlier, was about 120 million or so. And now with 330 million people, all brands in the United States have like 18,000 dealers or something. It's just a business where you've got a lot of worldwide competitors. They're not going to go away, and it looks like there are winners at any given time, but it doesn't get you a permanent place. Although, as I mentioned, I would say Ferrari is in a special place, but they only sell 11 or 12,000 cars a year, and U.S. last year, I think there were 14 million something, and it's not a business where we find it fascinating to be in. We like our dealership operation, but I don't think I can tell you what the auto industry will look like 5 or 10 years from now. I do think that you're right that you will see a change in the vehicles, but you won't see anybody that owns the market because they changed the vehicle. Charlie?
Well, the electric vehicle is coming big time, and that's a very interesting development. At the moment, it's imposing huge capital costs and huge risks, and I don't like huge capital costs and huge risks.
And we're subsidizing it in the United States, and we're actually doing it, putting in a pro-labor time. It is subject to politics like you can't believe, too. But it's going to be with us. We're not going to quit driving cars, and the American public has a love affair with them. But I think I know where Apple's going to be in 5 or 10 years, and I don't know where the car companies are going to be in 5 or 10 years. And I may be wrong, but that's Charlie and I follow the auto business with intense interest. Charlie's firm was the specialist in General Motors on the Pacific Coast Stock Exchange, and that was a franchise, wasn't it, Charlie?
Yeah, by working very hard, we can make a minor amount of money.
Buffett starts with a brutal history lesson. Henry Ford and the Model T. Ford literally seemed to own the world. The Model T was everywhere, dominant, unstoppable. And yet, just 20 years later, the company was losing money. Think about that timeline. 2 decades. In investing terms, that's nothing. If you can't predict where a business will be in 20 years, you don't have an investment. You have a speculation. And this isn't ancient history. The auto industry has always been this way. Buffett points out that the market is saturated with global competitors who never quit. There might be temporary winners, companies that seem dominant for a few years, but they never hold a permanent position. They can't build a lasting moat. Buffett makes one exception, Ferrari. But that's not really a car company in the traditional sense. It's a luxury brand operating in a completely different universe with completely different economics. For everyone else, it's a brutal, unforgiving battlefield. Then Buffett makes his most important statement. I know where Apple will be in 5 or 10 years, but I have no idea where car companies will be. This is the core of his investment philosophy: predictability, visibility, certainty about the future. With Apple, Buffett sees an ecosystem. He sees customer loyalty that borders on religious. He sees products that people replace every few years by choice, not necessity. He sees services revenue that's recurring and growing. He sees margins that are protected by brand strength and switching costs. With car companies, he sees none of that. He sees commoditization, price wars, massive capital requirements, and technological disruption that could make today's leaders irrelevant tomorrow. Charlie Munger goes even harder on electric vehicles specifically. He talks about the enormous capital costs required to compete in EVs. We're not talking about incremental investments. We're talking about rebuilding entire manufacturing infrastructures, battery supply chains, and charging networks. The capital intensity is staggering, and Munger adds another critical layer: politics. The EV sector is heavily influenced by government subsidies, regulations, and political winds that can shift overnight. One administration pushes aggressive EV mandates and tax credits. The next might pull them back. That's not an environment where you can build predictable, long-term returns. This is what Buffett and Munger are really telling us. Avoid businesses where your return depends on factors outside the company's control. Avoid industries where technological change can wipe out decades of competitive advantage overnight. Avoid sectors where brutal competition ensures that most of the value goes to consumers, not shareholders. The contrast with Apple couldn't be starker. Apple operates in a world where customers actively want to stay in the ecosystem, where switching to Android means losing your iMessages, your iCloud photos, your seamless device integration. That's a moat. That's predictability. Car companies operate in a world where customers will switch brands for a few $1,000s in incentives, where loyalty is thin, where the next technological shift, whether it's EVs, autonomous driving, or something we haven't imagined yet, could completely reshape who wins and who loses. Buffett isn't saying car companies can't make money. He's saying he can't predict which ones will or for how long. And for an investor like Buffett, who thinks in decades, that uncertainty is disqualifying. This is the lesson for all of us. Invest where you have visibility. Invest where competitive advantages are durable and predictable. Invest where you can reasonably forecast what the business will look like years from now. If you can't see the future of a business with reasonable confidence, you're not investing. You're gambling. And Buffett doesn't gamble. Thanks for watching Investor Insight. Subscribe for more insights into Warren Buffett's investment strategy. And remember, predictability beats potential every time.